Thanks for joining us today on Market Call. I'm Mirella Fernandez. Stan Wong with us on the show, portfolio manager at Scotia Wealth Management, taking your questions today on North American large caps and ETFs. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can email your questions as well, marketcall@bnnbloomberg.ca. Stan, good to see you.
It's great to be here. Happy New Year.
Happy New Year to you.
Thank you.
What do you think will move the markets this year?
Well, I think after 3 strong years of the S&P 500 index and a solid showing from the TSX this past year, I think it will really be about monetary policy. Where we head there, we assume that we're going to have a new Fed chair, which is also dovish, but leading up to that, it might be some volatility. And speaking of volatility, we've got the renegotiation of the USMCA. We've got midterm elections, and typically when you have midterm election years, they tend to be the most volatile, and you tend to have the highest drawdowns. They still may be positive. Historically, they are positive, but you're going to see a lot more volatility, typically in these types of years. But, everything underneath that is fairly supportive. We have an expectation of about 14% earnings growth for the S&P 500, so that's positive for sure. And again, we see inflation that is easing, which will also support more accommodative monetary policy, which is constructive for stocks.
Do you think that investors will still have concerns about valuations that they did last year?
Absolutely. Valuations are higher right now. So it's more about the earnings results and the earnings guidance rather than the narratives around many companies, including technology companies.
Okay, so what sectors are you interested in for 2026?
I still think that there's a great momentum and great growth in many of the technology and communication companies out there. We like healthcare as well and financials, and I think industrials have a path to outperformance as well.
Okay, are there a couple of sectors you like this year better than you did last year? And if so, what has changed for you?
Well, obviously, technology and communications performed very well last year. With that being said, you look at the Mag 7, not all of the Mag 7 companies did very well. Only a couple of them outperformed the S&P 500. I think we're shifting to a little bit more of the industrials, a little bit more of the financials, probably not really lowering our weight to technology because I still think there's a pathway for technology to perform well. But again, keeping in mind we'll have more volatility this year, and it'll hit the higher beta type of sectors like technology.
Why are you anticipating more volatility? I also wanted to ask you about, you said the midterm years tend to be a little bit bumpier. I thought, generally speaking, they'd be a bit calmer because of the midterms, and you're saying the reverse is true. Historically,
I think some of the trepidation about the change in government do lead to higher drawdowns or greater drawdowns in midterm election years. Midterm election years tend to be one of the weaker years of the presidential cycle as well. However, volatility can lead to opportunities where we can purchase things that have gotten a bit cheaper, just like we saw last April with Liberation Day.
Okay, let's take a quick break. Then we will line up the first of our phone calls for Stan Wong. He'll take your questions today on North American large caps and ETFs. Back in a moment. Welcome back to Market Call. Thanks for joining us today. Let's start with an email from Pat. She says, could I please have your thoughts on Boston Scientific, BSX, on the New York Stock Exchange? We'll start there with Stan Wong, who's our guest today. They do, I guess, medical instruments. Is that correct?
Yeah, it's a leading global medical device company, cardiology, endoscopy, and so forth. I mean, I think long-term aging demographics and rising volumes and procedures is beneficial for a company like Boston Scientific. You'll see long-term durable organic growth in earnings and revenue. However, if you look at the technical structure of the stock, we're seeing a little bit of near-term technical weakness, I think partially because valuations are a bit high on this company. Share price has fallen below its 200-day moving average more recently, and that 200-day moving average itself is starting to trend a bit lower. So from a technical perspective, it's something to watch out for. In the healthcare space, I prefer some of the larger pharmaceutical companies and some of the more logistics type of companies, some of the delivery companies like McKesson and so forth.
As opposed to the instrumental
as opposed to the
providers.
Medical devices.
Yeah, got it. Okay, let's go to the first caller today is Craig. He's on the line in Kelowna, BC. Hi, Craig.
Good morning. My question for Stan is on industrials, which he spoke about earlier. And the specific question is, could he recommend some ETFs? And are those either global ETFs, Canadian ETFs, or U.S.? Or are there certain names, specific stocks he'd like to recommend for infrastructure, or not infrastructure, industrials, sorry.
Okay.
And this is for my RSP or TFSA. All right, thanks very much.
Thank you for the question, Craig. So would you go the way of an ETF for industrials, or would you go with a specific stock picks?
I think it depends on the size of the portfolio and how much diversification an investor needs. XLI in the U.S. would be one of the first names that come to mind. It's an ETF that will include names like Caterpillar, RTX, GE Vernova, and Boeing, and so forth. Fairly inexpensive ETF at just 8 basis points expense ratio. Within specific names, I mean, some of the names we like would be Caterpillar. GE Vernova has great long-term aspects to it as well. But depends on the sizing of the portfolio. You can choose an ETF or you can choose the individual names.
Are you expecting a sort of a boon for industrials because of the build-out across North America? And if so, would you look at global players in the space?
With the events that occurred in Venezuela, obviously it's a longer-term type of thing, but we certainly see the path for more infrastructure build-out around the world. Obviously, some of the U.S. names are multinational names, so I would maybe stick with some of those names. But there are some global names out there. But I think the U.S. names will get you far.
Okay, let's get to our next question, which is in an email from Mike. He says, why is Tesla so volatile? That's a very wide question. Let's take a look at Tesla and how it is doing lately. It's up at 434.85, 435, so up 10% in the year. And it is a chart that does kind of go all over the place, up generally, but a lot of pits and valleys. So do you like Tesla, first of all?
To answer the question why it's so volatile, it really comes down to the valuation. You're looking at a stock that is trailing PE at 310, forward PE at 215. Even if you put a 30 or 40 or 50% growth rate on that, you're still looking at well over 4 times PEG ratio. So I think what happens with this particular stock is that with high valuation, you've got high execution risk. So investors are watching at production, looking at how much deliveries there are. There's certainly margin pressure from competitive pricing, competitors out there from the different companies that are out there. Yes, Tesla has robotics in front of it, but that's only about 10% of their current revenues. It will grow over time, but that's in the future again. So I think it's really heavily weighted towards future expectations of growth. And that's why, investors look at, they're very sensitive towards delivery numbers and production guidance and kind of the macro sort of economy. And that's why that stock is very volatile. And to answer your question, it's not a stock that's in our portfolio. We just find that the valuation metrics are a little bit too extended for us. There's many different tech-oriented names out there. And if you look at 2025, GM did a lot better than Tesla in terms of performance.
Okay, Tesla, also, I'm just wondering, do you expect more competition in the EV market? I know Ford, for example, is drawing back on production in EVs. We know China's dying to get into the North American market with its product, which would be cheaper. Do you foresee more competition in that space, which could eat up into Tesla's value?
Yeah, it's really ebbed and flow. I mean, a lot of the companies like Mercedes and Ford were going very heavy and had very high expectations for what they're going to produce or their market share of their own vehicles in EV. And then I think demand kind of waned a bit, and now they're pulling back a little bit. But there will always be competitors out there, whether it's Volkswagen or Mercedes and Ford and so forth. But I just think that with this type of stock, it's really a larger retail investor base that's purchasing this type of company or stock, and you're going to have more volatility with it.
Okay, let's get to another caller before a break. Jack's on the line in Toronto with a question. Hi, Jack.
Hi, Marilla. This question is for Stan. Stan, how you doing? I have a question regarding Citigroup. I was wondering, I'm looking to get into it. Do you hold it? I'm looking to get into it. At what price do you think I should get into it? What do you think of this stock, Citigroup?
Okay.
Thank
you for the question. We didn't really talk too much about financials, but Citigroup at 121, it's up 65% over the year, and it's got a nice sort of trend up and to the right. Would you put money in at the level it is at today?
Well, generally speaking, I like U.S. financials and I like U.S. mega banks out there. Citigroup is not one of them that we own. I own Goldman Sachs, and we'll talk about another major bank that we own in the top pick segment. But the stock's done very well. Citigroup is up about 70% in the last year, so we like it. We just like some of the other names a little bit more. Great technical chart involved with this particular name, so nothing to complain about this name. Price to book ratio is still pretty reasonable at 1.12 right now. So we just don't own it. We have a couple of other names that are a bit more growthier in our portfolios. But I like U.S. banks and U.S. financials.
Okay.
I think if I can add, if we see lower oil prices down the road, it's obviously going to be beneficial for the consumer. It'll have less loan losses for banks. It'll have better credit and delivery. So that might benefit for financials as well.
Okay. Let's take a quick break. We'll line up some more phone calls and some emails for Stan Wong, Scotia Wealth Management. Again, he's taking your questions on North American large caps and ETFs. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. John's been holding on the line. He's in London with a question today for Stan. Hi, John.
Thank you, Marilla. Hello, Stan. Stan, my question's on defense stocks. Mr. Trump has described a $1.5 trillion dream military in Canada. I just added to MDA Space, which signed a deal with the U.S. SHIELD program this morning. In the U.S., I own Palantir, Axon, and I'm looking at Raytheon RTX. Raytheon stock's going up. What do you think about Raytheon for a 2 to 3 year hold? Thanks very much.
Okay, thank you for the question. Yeah, a lot of movement on defense stocks, obviously, after sort of competing comments from the U.S. president. Not only does he want to spend a lot on military, but he also doesn't want them to pay dividends or buy back their shares so that they can put more into putting out product. So would you still be interested in defense at this point if you have been? And what do you think of RTX?
We certainly saw a lot of whipsawing with the comments yesterday. RTX hitting a brand new 52-week high today. So, certainly the technical structure of the stock is excellent with higher highs and higher lows, trending upwards. 200-day moving average, long term is moving higher. The only thing I would be concerned about is that we're seeing a little bit of extended valuations here. Yes, talk about more spending in the defense side, but we need to get that through, and that actually has to happen. So we're now looking at about, given the fact that forward PE is nearly 30 times and the earnings growth rate for RTX is about 10 times, you're paying 3 times PEG ratio, which is a bit expensive for what I'd like to pay for most companies, including industrial companies and defense companies like RTX.
Okay, so would you wait sort of to see if there's a bit of drawback?
Yeah, I think so. Certainly we see, great technical structure here, so it's hard to say where this will drop back down into that'll make it more attractive, but perhaps you can use the 100-day moving average or the 200-day, which is very far from here at 154. The 100-day is closer to 167. Of course, that 100-day moving average will continue to trend higher as the stock moves higher.
Okay, let's move on to another caller then. Elliot's on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. Please, may I have your thoughts on the potential Netflix acquisition? And on a technical side, is it forming a base around 90? And if it breaks that, what next? Thank you.
Okay, thank you for the question. Netflix, a lot of action, of course, with the move to purchase Warner Brothers, but of course, another bid coming in from Paramount. Netflix down to $89.94. I guess Elliot wants to know if there's going to be a bounce back off of that floor or somewhere in there.
Yeah, I mean, we own this stock. We've held it for quite a while, and we've done very well with this stock. I think that the name continues to dominate. I mean, if you look at a few years ago, we wondered which streaming service was going to dominate and be the giant. It's clearly Netflix. And now with this potential acquisition of Warner Brothers, it's going to be even bigger. And that's what the market is really concerned about, is how much they're spending on this. But it's all about content. Content brings on more subscribers, brings on more viewers, and creates that ecosystem that Netflix has been building on in the international markets. I still like this stock. I think that there could be a little bit of support level at the $80 level, $81 level, which is we're not too far from at this point. Longer term, they'll continue to build their subscriber base, especially with this acquisition, taking on sports like NFL football and boxing and WWE wrestling, if you consider that a sport. is a new frontier for Netflix because, again, not too long ago we said, well, cable is where we have live sports, and now we have live sports in streaming networks,
yes,
in Netflix, in Amazon Prime, and so forth. So I continue to hold this stock. I'm a buyer at weakness here. I think that there could be some support level at 80. I think we just need to the investors need to get past this spend for Warner Brothers, make sure it's done. Warner Brothers has rejected Paramount, I believe, twice at this point. So I think it's a done deal that it's going to go to Netflix.
Any valuation concerns here?
No, not at all. If you look at the stock, I mean, we're still looking at very, very strong earnings growth in the company. And we're paying 29 times earnings at this point, which is in a lot of ways cheaper than names like Walmart and Costco and so forth. And we're seeing 25% growth going forward. So I think the valuation is very fair at this point.
Okay. Let's move on then to Trevor, who is in Arizona with a question. Hi, Trevor.
Hi, my question is on Visa, credit card processing company. Mr. Wong, this stock, currently the PE ratio is 35, and I can almost never recall it being on sale. So does that mean there's an expectation built in this stock will keep going up? If you can comment. Thank you.
Okay, thank you for the question. Yeah, Visa's been going a little bit sideways, which is unusual for the companies. What are you thinking?
Yeah, it has, and it's a name that we hold in our portfolio and alongside with MasterCard as well. And we've held these names for quite some time, and it's done very, very well for us. I think when you have a name like Visa, one of the things that I really like about owning companies that are in industries with very limited competition like Visa and MasterCard is that they dominate how they charge. They dominate the revenue, they dominate the earnings, they control those. There's very few players beyond MasterCard and Visa that can upend them. I think that they're getting into more technology advances with their payment system. You're paying 27 times forward earnings for a company that's growing at probably 15 times plus, 15% or more going forward. I think that's a very good valuation when you're talking about a company that really has one major competitor in front of it. So I like this name. Technically, it's been weak, hasn't really participated in the market movement of last year. But remember, the S&P 500, when you're comparing that, is 40-50% tech and communication names. So it's still above the 200-day moving average today. It fell below that, but that 200-day moving average long term and the weekly average is still moving higher. So we still like it. With that being said, it was up 14% in the last 12 months, which is not that bad.
Okay, let's move on to another caller. Ben's in Kingston, Ontario. He's got a question today. Hi, Ben.
Hi, thank you very much for taking my call. My question is on Boeing. I don't know if you do own or have you ever owned Boeing, and I see some kind of resistance around 230. What is your opinion on Boeing going forward? Thank you so very much.
Okay,
Take care. Bye-bye.
Thank you for the question. So you saw Boeing sort of trend down end of last year, November and December. It's coming back on now. Would you say that a support level there, I guess it's a 180, it's up to 229 today?
I mean, I think from a technical perspective, the 200-day moving average is slowly trending higher, which is positive. The price is above that, which is positive as well. Boeing is not typically a name that I like to add into portfolios, just given the type of products that they have. Those types of aerospace type of products can be very volatile given what's happening in the world. If there's issues, product controls and so forth. So that can really whipsaw a company like Boeing, and that's why we tend not to be in that space. Deliveries can be affected by the macroeconomy, could be affected by oil prices, although oil prices are low and we expect to be potentially lower going forward. So I'm very neutral on this particular name. I think that if we were going to be in the industrial space, we'd probably veer more towards the pure defense side rather than Boeing, which is a combination of aerospace and defense.
Okay. Let's take a quick break then. When we come back, we'll have a look at Stan's past picks. That's next. Time now to have a look at Stan's past picks from January 8th of last year. The first one was Financial Select Sector SPDR Fund. So this is an ETF that works on the U.S. financial sector sort of correlation here. It was at 48.49 U.S. at the time, so a year ago, to 55.97 today, a 15% return and a total return of 17%. Why did you choose this ETF? Do you still hold it?
Generally, we like U.S. financials, and we've liked it for the past year or two. With this ETF, we continue to hold it. With this ETF, you're getting the best-in-class U.S. banks and brokerage companies, such as J.P. Morgan, Goldman Sachs, and Morgan Stanley. We'll talk about one of them in the top picks. We see earnings recovery. Rate pressures are easing, which will lead to better net interest margins stabilizing and a steeper yield curve in 2026. So that's all good things for banks in general that will reaccelerate profit growth. We see a lower tax rate in the U.S., more deregulation in the U.S. That's beneficial for financials. Excess capital is flowing back to shareholders via buybacks and rising dividends. And I think there's still a valuation gap measured. It's at a discount to the S&P 500. The financial sector is trading about 18 times earnings, and the S&P 500 is at 26 times PE. So I still think that there's a path for more outperformance from financials going forward.
Okay, that was the Financial Select Sector ETF for you. Let's go to your next past pick. Well-known name, NVIDIA, at the time was 140.11, and now it is at US 184.94. It's kind of been hanging around the 185 up to 190 more recently. A 32% upside, a 32% total return. A lot of analysts I speak to say, yes, NVIDIA is still going to grow from here. They've still got a lot of income. They're still selling a lot of microchips. Where do you see the growth for the company this year? Is it the Chinese market? Is it just sort of the same course they're already on, more chips?
Well, the Chinese market is volatile because one day you can ship and one day you cannot, as you know. I look at the numbers, and this stock is trading still below 1 times PEG ratio, and it's cheaper than it was several years ago when you look at the PEG ratio and growth relative to PE. It is still the AI infrastructure king. It's a backbone of this global AI arms race between all the hyperscalers, and that demand will continue to be anchored by names like Google and Meta and so forth. Their software, the CUDA ecosystem, is very embedded across enterprise systems and research platforms. That's not going to be displaced easily. So we like companies that are fully entrenched into the economy, into the social space. The scale in data centers will continue. I don't see that growth in data centers around the world in the U.S. slowing down. Growing software content, the more we talk, the more we have videos, that's going to continue to drive more data centers, more cloud business, more operating leverage for a company like NVIDIA. And I will say that we wrote a blog about it not too long ago on our website. We are still in the early days of this artificial intelligence, robotics, autonomous revolution. I would argue that we're in the early innings of this adoption. Some of our clients that are in the tech space will say we're barely in the first inning. If I were to guess, we're probably in the second or third inning of this adoption. And you just have to look at the data, you look at the earnings, you look at the valuation levels. They're nowhere close if you were to compare it to the dot-com era. The dot-com era, it was a time in which there were companies that earned nothing and still had major valuations. Okay,
so there's growth to come, room to grow for NVIDIA. Let's get to United Health. Your last pick from last January to 524.52 US at the time, down to 345.99 today. So a 34% drop, a total return of 32% drop. And of course, this is a company that has been facing a number of different issues over the last year. You probably picked it just before, I imagine, some of that hit. Are you still invested in this? Have you trimmed back? What are you doing with United Health?
Well, fortunately, we actually sold it on April 8th at about $560, and we made money on this name. Okay. It was a bit of a quicker trade for us, and our portfolios are pretty high turnover. It's about 40% turnover on names. But fast forward to today, United Health has gone through a lot of different things: leadership change, the tragic death of their CEO, regulatory scrutiny, higher costs than expected because of elective procedures happening, post-COVID and so forth. But the chart has improved somewhat, so it is on our radar. It is still below the 200-day moving average, but we see this sort of basing pattern happening. If it breaks above the 200-day moving average, that could signal a pretty positive technical radar screen, basically. So I think some of the selling pressure is being worked through. We see some major investors and institutions and hedge funds buying this name as well, as you know, in the past 6 months or so. I think that earnings visibility is starting to stabilize as well. We don't own it again now. We took profits, as I said, in April of 2025, but it's on our radar.
Okay, one to watch. All right, we're going to take another quick break. Stan Wong sticking around to take your questions. Back in a moment. Welcome back. Thanks for joining us. We're going to go to an email from Michael, who says, I wonder if Mr. Wong has a positive outlook for either Lilly or Novo Nordisk. Thank you very much. These are pharmaceutical companies. Everybody's competing these days with their weight loss drugs, of course. What's your take, first of all, on the space, pharma?
We own Eli Lilly. We used to own Novo Nordisk, and we continue to hold Eli Lilly today, of course, and that stock is breaking out to new highs. And it's a bit more diversified than Novo Nordisk, and that's why you get a bit more stability with it. Novo Nordisk is highly diabetes and weight loss drug. Now, Novo Nordisk announced very recently the pill for one of their drugs. So that was very positive for the company. The Ozempic pill is the pill format is the next stage. Eli Lilly will come up with a pill format with their drug sometime this year, I believe. When you look at Novo Nordisk, the valuation is quite cheap at this point. The stock's really gone through a lot of challenges with competitive pricing from generics, regulatory scrutiny, and so forth. But recently, Novo and Eli Lilly signed a deal with the administration in the U.S., the government administration, to expand Medicare coverage, but to lower the prices. But the expansion is more important. Novo Nordisk is trading at 17 times earnings right now, but their sort of earnings growth forecast for the next couple of years looks a little cloudy. The price is seemingly building a base, but similar to United Health, it's still just a tad below the 200-day moving average. So we got to be careful there. I prefer Eli Lilly at these levels. They continue to perform very, very well. Stock price recently made a huge jump after being flat for a long time. It's well above the 200-day moving average, and more positively, the 200-day moving average is starting to push up a little higher. But I think that clearing event with what we call a clearing event with the deal with Washington to basically expand Medicare, that's big for Pfizer, Eli Lilly, Novo Nordisk, and so forth.
I think a lot of people were waiting to see what would happen on that front before they wanted to put some money back in. Okay, let's go to Anita. She's on the line in Markham, Ontario, with a question. Hi, Anita.
Good afternoon, Mirella and Stan. Thank you for taking my call. My question is on VEU, Vanguard FTSE All World Except U.S. Index Fund. Stan, I don't have much exposure to global market except a bit of VEE that I own. So I'll appreciate your advice on this. And what percentage of my portfolio should be on this? I'll hang up and listen to you. Thank you so much.
Can you tell me a bit more about the ETF?
Yeah, so this is basically a global ETF of equities ex-US. And I think it's timely because the US has performed extremely well, but quietly international markets have performed as well, if not better, actually better last year. We're seeing lower valuation discounts with international markets. We're seeing a weakening US dollar, which is obviously going to benefit global equities or international equities. You've got lower price to book, better dividend structure. There's about a 3% dividend from this particular ETF. This ETF, you're paying about 4 basis points. So you're getting exposure to the entire world outside of the US. So it's great diversification. To answer the question of how much you should have there, I need to know a little bit more about the investor. However, anywhere from 10% to maybe even as high as 30% makes sense to have international exposure in the equity portion of your portfolio.
All right. Okay, let's move on to Ian. He has written in from New Brunswick. He says, what are Stan's thoughts on Meta? Is this a good entry point for a long-term hold? We'll pull up Meta. In the tech space, how does Meta stand out? I know they've pulled back on some of the investment they were doing in sort of the Meta world, and now they are sort of focused on other things, but they're still down. 643 is where they are today, trailing at the end of the year. Are you invested in Meta? Do you like Meta as an investment idea?
We do own Meta in the portfolio, and it's one of these Mag 7 stocks that really didn't perform all that much over the past 12 months. It's up about 6% in the last 12 months. With that being said, the shares are trading at 22 times forward earnings with about a 14-15% growth rate, PEG ratio. You do the math, it looks pretty decent from there. The stock is just slightly below the 200-day moving average, but not to worry. I think the 200-day moving average continues to move higher. They'll be at the forefront of the technology revolution and artificial intelligence and so forth. So we continue to like this name. Investors have always been kind of concerned about how much they're spending in the Meta space and so forth, and they've kind of went far and then they kind of pulled back, and investors kind of like that a bit. But I think long term, this is one of these names that will be part of this, one of the few names that it will be the leadership type of names.
Yeah.
Exactly, yeah.
Benefit from AI. Okay, that is Meta. Let's go back to the phone lines. Humesh is on the line. He's in Markham, Ontario as well. Hi, Humesh.
Hi. Thanks for taking my call. I want to know more about BX, Blackstone on the New York market.
Okay, thank you for the question. Blackstone, can we take a look? Here's the chart. It's a pretty volatile chart, down again at the end of last year from a high in the fall, and now sort of trailing off sideways. Blackstone Group, first tell us a little bit about them.
Yeah, so really it's an alternative investment manager that focuses on real estate, hedge funds, private equity, leverage lending, credit, and so forth. So the news yesterday from Trump saying that he doesn't want large institutions to own individual homes or residential homes hit companies like Blackstone, and it was down a little bit. I think long-term Blackstone makes a lot of sense, but in the short term, the stock has really been quite sideways over the past year to negative, especially with yesterday's news, and therefore the 200-day moving average has kind of floated downwards a bit. For me, I prefer some of the more traditional financial names, whether that be Citigroup, Wells Fargo, Morgan Stanley, Goldman Sachs, a bit more than names like Blackstone, because with these types of names, you're going to see a higher beta profile. Blackstone's about 1.2 times beta, and news like that will affect the pricing of these names.
Okay, that is Blackstone. We're going to leave it there right now. We will be back with Dan Wong, Scotia Wealth Management, taking your questions on North American large caps and ETFs. We're back in a moment. Stay tuned. Welcome back to Market Call. Let's go to an email from Sean. He says, do you think there's going to be a large upside to Tourmaline stock with the development of the LNG port in BC? This is one of the infrastructure projects the government wants to push forward and work on. Tourmaline sitting today at 58.35, so down a little bit on the day and down about 15% over the last year. Are you invested in Tourmaline? Have you guys dipped into Tourmaline before?
We don't have any Canadian energy names in our portfolio currently. LNG Canada, the port, is clearly a long-term positive for Tourmaline. It opens the door to global gas pricing and tightening supply-demand balances for Tourmaline. However, I don't think there's any immediate or near-term surge expected from the stock. We kind of know that this may or should happen in the next little while with the terminal coming online at some point. I think really the upside, we really want to look at what's LNG prices doing around the world. What's the NYMEX Henry Hub prices, which is negative. It's been down. It's below the 200-day moving average, and so is the Tourmaline oil stock as well. How quickly will export volumes ramp up? So I wouldn't purchase this name based on the fact that this terminal will and should be coming online. At some point, it's kind of known into the market. It's really about supply and demand and more about natural gas pricing.
What would have hit natural gas prices more recently that have taken it down?
What would have
Because usually you're thinking in the winter, perhaps there would be more interest in natural gas. People are heating their homes that way. We know there's appetite in Europe for it, but it really has sort of dragged down. Is there anything obvious that would have hit it? Well,
I mean, the movement of it is clearly constricted in Canada, and that's been a problem as well. And I just think that if you look at energy prices in the commodity space, that's been the loser for the last while. And the winners have been precious metals, and more recently, base metals have been performing well. Agricultural commodities are kind of sideways a bit. But in general, I just think that with energy prices looking to move down on the oil side, I'm not sure if we'll see a big ramp up in natural gas prices
anytime soon. Okay. Let's go to a caller then. Robert is on the line. He is in Montreal today. Hi, Robert.
Hi, Stan, Marilla. Your thoughts on MAGs, ETFs, long term? Thank you.
Thank you for the question. So MAGs, I would take it, mimics the top 7 tech stocks that we all talk about. Is this one you like?
I think in general, I like some of the names in the MAG 7. And because it's only 7 names, I'd prefer to just purchase the names in which we really like. And depending on investors' base in terms of the value of their portfolio, I think they should do the same thing. Like certainly this ETF has done decently over the last year, up about 21%. But, I have reservations about Tesla and also Microsoft in this particular, out of the 7 names. We do own all the other ones, Apple, Amazon, Alphabet, Meta, NVIDIA, of course. I'd rather choose the few names that you really like and make sense in the portfolio. And I think from a pricing perspective, you're paying 29 basis points for that. It's not as though you're getting extreme diversification with this particular ETF like you would with an international ETF or a sector ETF for that matter. Not sure if it's really worthwhile to purchase an ETF when you can just purchase 4 or 5 names that really make sense within this ETF.
Okay, let's go to an email then from Calgary and Paul who says, what is your outlook on Caterpillar? Caterpillar had a pretty good quarter last report. And would you be interested in Caterpillar knowing the infrastructure build out expected in North America in the next few years?
Caterpillar is a name that we've owned, we've taken profits on, and clearly the stock has moved forward, so we might have taken it a bit early, but we did well with it. My concern right now is that the PE's near the 10-year highs at this point, so valuation is getting a little bit tricky for this particular name. When you look at the PE relative to the growth, you're paying about 29 times forward earnings for about 11% growth rate. That's a little bit expensive for an industrial name like Caterpillar. So I love the name. I think it makes a lot of sense. We will see more infrastructure build out. Caterpillar is doing a lot of things like adding technology and AI to what they're doing, making things more efficient. However, I think the valuation precludes me from buying it. I'd look for a bit of a dip before going into it.
Okay, let's get to another email from Kim. Can I please have Stan's opinion, he says, on Lennox International. Tell me about Lennox.
So Lennox is your air conditioners and heating and cooling and so forth type of company.
Will they benefit from AI build out, data center, that kind of thing? Are they involved with that?
Yeah, I'm not sure. I think they're more into the commercial and the residential. I'm not overly certain about the
sort
data
of industrial
center. Yeah, that type of thing. I think a name like GE Vernova would benefit from that industrial commercial data center AI build out. This is a stock we've owned before. We sold out of it. It's really been kind of sideways. The 200-day moving has been falling slightly in the last little while, and the price is now below that now. So difficult to really understand why that is, because I think that they're one of only a few names in this particular space. So long as the global economy continues to grow and the population growth continues, and as we, for environmental concerns, have to replace air conditioners completely, not just replace parts, this name should benefit. However, it has not. They've actually cut forecasts more recently, which has sort of affected the stock more negatively.
Interesting. Okay, let's take a quick break then. We will come back with Stan's new top picks in just a moment. Stay tuned for that. If you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. And you can watch full episodes, of course, on our YouTube channel. And then tomorrow on Market Call, Colin Czasinski will join us on the show. He's Chief Market Strategist of SIA Wealth Management. They'll take your questions on technical analysis. That's tomorrow. And time for new top picks from Stan Wong. First one we talked about a little bit today in a larger scheme, Amazon.com on the NASDAQ. I know you're invested in a number of the Mag 7. What do you like specifically about Amazon moving forward?
I think what I like about Amazon today is the fact that it really lagged the Mag 7 and the S&P 500 over the past 12 months. And when you look at the fundamentals, it's only been getting better. Today, it's not about the e-commerce, it's more about the AWS cloud system and the advertising. Those are the primary drivers of profitability for Amazon, and that is growing faster than the core retail business. We're looking at about almost $800 billion in revenue for 2026 fiscal revenue, and the earnings are going to grow about 19%. With the stock around 30 times forward earnings, that's only a 1.5 times PEG ratio, which I think is pretty inexpensive. You've got 200 million global Prime subscribers, and that is growing as well.
Look at that, 82 buys.
Yeah,
Wow.
So I just think this stock was left behind for whatever reason in the past 12 months. I mean, it's still up, it's done okay, but S&P 500 obviously is stronger. And you look at margin expansion, and you think what Amazon is all about. I took the kids a number of years ago to the Amazon warehouse. You get to do a tour, and everything's all robotics. And now the AI and robotics being used is greater than ever. It's been building every single year. That's being deployed across all their fulfillment centers and their operations. That's lowering costs, driving margins, operating margins higher with the use of AI. And obviously AWS and AI at Amazon is top notch. The robotics are getting greater. And that's really leading to me, a pretty good technical setup with the shares lagging last year, but the fundamentals are still moving higher. You look long-term, you pull the chart out further, the long-term trends remain very intact with trending higher 200-day and 200-week moving averages.
Okay. Amazon it is. Let's go to your next pick, which is Invesco DB Base Metals ETF. You think base metals are going to go this year. Give me your ideas behind that and why this particular ETF is the way to go.
Yeah, so 2025 and maybe this year, gold and silver were the winners. Silver really, really outperformed gold, more than double. Base metals tend to follow when precious metals surge. So this ETF gives you access to copper, aluminum, and zinc. These are the backbone metals of the global economy. Copper has reached all-time highs. Aluminum and zinc have broken out to new 52-week highs. And as you can see with this chart, DBB has performed very well. And as I said, precious metals have already surged. We own silver in the portfolio. We'll continue to hold it. But historically, base metals follow that surge in precious metal prices. So I like DBB for that exposure. Obviously, it's base metals, so you're going to see a bit more beta in the stocks, a bit more in this ETF, it's more volatile. But long term, you got to think about AI and infrastructure catalysts, data centers, EVs, grid upgrades, electrification. Those are all extremely metal intensive, and that reinforces that demand momentum. When you look at the sort of the global macro picture, the OECD leading indicators are pointing to greater momentum in the global economy, which is good for base metals.
Okay, that was the ETF for base metals there. Let's get to your last pick, JP Morgan Chase. We talked about financials, especially in the U.S., which you like. Why JP Morgan Chase in that space?
So we own Goldman Sachs alongside JP Morgan, and I talked about Goldman Sachs in our previous segment in November. JP Morgan is the largest and most diversified U.S. bank available. It has leadership in retail banking, wealth management, and capital markets. We're looking at about $200 billion or just almost $200 billion in fiscal 2026 revenue. There's a capital markets recovery underway. Issuance and advisory activities are turning higher, and JP Morgan is always part of those deals. A lot of investment in payments technology from JP Morgan, automation, analytics, that's driving operating leverage. A lot of talk about AI being very, very beneficial for financials next.
In the back room.
In the back room, being able to provide better experiences for customers, providing more efficiency for employees and so forth, and giving better, stronger engagement. I think with an environment where we see more deregulation in the U.S.
I was going to say, are they going to benefit from the big, beautiful bill?
It should benefit from that. We'll see, less regulation, lower tax rates. That's going to help consumers. That's going to lower credit issues and increase, more credit offering and lower loan losses, what I should say. I think these are all beneficial things for financials.
And you think they'll all benefit from that time. Okay, so I guess we'll see how that rolls out in this coming year. Thanks for joining us today, Stan. Appreciate it.
Great to be here.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.